Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure of speaking with Ron William, CIO and strategist for RW Advisory. By the way, I should say before we get started, tickets for the upcoming in-person crypto gathering in Miami are now up for sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Ron, always a pleasure to have you with us. Today, great conversation on tap, talking about the election and the election aftermath in markets. 50,000-foot overview, Ron. Where are we right now?
Great to be back, especially with this thematic and timely moment into year-end, post-election. And certainly our main strategy playbook is election fever, buy the fact, fade, buy the rumor, I should say, fade the fact. So we're looking for a potential extended and hotter than expected market, which will likely unwind as profit taking kicks in, and a policy reality check also starts to unravel into the new year. So certainly more of the same in terms of risk proxies being strong, predicting the outcome of a Trump and Republican win, albeit the big surprise was that it was so decisive, so clear and broad-based in terms of the red sweep. But stronger markets, which still pressures that potential mean version risk that we've been discussing in previous sessions.
Ron, I know that you've got some research that you want to walk us through here today. You've done some extensive deep dive on exactly this topic. Let's jump in.
Yeah, sure. So the opening picture speaks 1,000 words, but through a cartoon to enlighten us, but also to bring us on topic and to check some of those behavioral biases that continue through all market dynamics. Is credit to Hedgeye, the 50-50 coin toss outcome, which eventually was predicted in favor of Trump and Republicans. And I'm playing on the old song Fever by the rock and roll star Elvis Presley. But the big play there is that fever isn't a new thing. Fever started a long time ago in the sense that euphoria has been here for such a long time. It just got even hotter going into the election. And the big concern remains, even though markets did predict that result into November 5. Here we see rates, long-term 10-year rates in blue, risk surging higher, in line with my prediction when we last spoke. Most people were looking for rates going down lower. We made a low, found support, and then pushed up higher. That was partly an inflation resurgence backdrop, which remains according to market charts, cycle timing, but also some of the data that's coming out.
Ron, let me just make sure our audience understands this chart here, because you're transposing the U.S. 10-year Treasury yield against Trump win odds on Polymarket. The suggestion here, the implication being that as the odds rose of a Trump win, so too in the same proportion you saw the odds rising of increased 10-year Treasury rates, as you point out, presumably because of the implication of inflation.
Yes, through expected fiscal policy in a Trump Republican administration, but also we saw a revival of animal spirits in the sense expectation for stronger economy, stronger markets, with optimized taxation, deregulation, and other market and economic friendly policy. So case in point, S&P 500 back to all-time highs. Bitcoin, as we speak, at a new six-figure glass ceiling, 100,000. So all of these were the risk proxies that not only became more euphoric and ultimately consumed by the election fever, but also predicted the result that we now have confirmed after the fact. The big surprise was the fact that it was a fast, clear, and decisive win, more so in the sense of the broad red sweep, and the fact that the House and Congress is also likely one, and therefore policy mechanism would likely be that much more streamlined. So that was a little bit more of a supercharged upside surprise, which took markets higher than expected. But all in all, in the weeks going into the election, there was an expectation for the final result. It was only the month before that it was 50-50 coin toss territory. And then as the countdown began, markets were certainly pricing in what is now already confirmed.
By the way, talking about 50%, I should say that as the vote counting continues, former President Trump now at 50%, Vice President Kamala Harris at 48.4%, so just over 1.5% margin on the popular vote.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
Interesting event risk, which is now passed. And certainly we've seen a risk clearing event with markets continuing strong, but also potentially overheating and the future risk of an unwind. And so this brings us into pattern analysis based on past elections going over 100 years. You can see here on the chart on the left, this two-stage predictive move, which plays into the old well-known saying, buy on the rumor, fade the fact. So going into the election, there's an upsurge as markets factor in that potential POTUS outcome. In this case, it was more correct than wrong. And then typically what happens is going into year end, yes, we euphoria and the fever continues, but remember this is a fever of a existing fever in terms of market euphoria, which continues. And that then creates a profit-taking opportunity into the new year, coupled with a policy reality check. And that typically happens for each election cycle, particularly if it's a new incumbent. And I would say more so, and this is based on political commentators, if there is a disruptive policy change, for better or for worse, that initial change, of course, can create some market volatility. So that's what is likely expected into Jan 20. And then just keep in mind that the midterms typically produce an underperforming market as new leadership develops, rolls out new policy, in this case, potentially more disruptive than most, then that takes some time for it to roll out, impact, and for both the economy and the market to adapt. So this is what the chart on the right shows, that the average trajectory is sideways, underperforming with elevated volatility.
Ron, let me ask you this. Obviously, we're looking at aggregates here. I'm guessing this is probably something like an arithmetic mean of all of those data sets that you put together. Are there any outliers? Does the distribution always follow the same pattern as the central tendency, or are there some outliers here that could potentially show more optimistic or more pessimistic news for the potential implications of these data sets?
Yes, absolutely. And good point. With all data, there's a base case, and then there's best and worst. And certainly I'm right here and now presenting the average typical historical analog. Now it's the pattern that we're looking at, not the repetition. That's the educational disclaimer that I often share, in the sense that we're looking at the behavioral implications to market reactions, in this case of macro event risks such as presidential elections. But exactly to your point, there can be variations. And so those variations, it's worth looking back in time and seeing whether it's administrative related, whether it's policy impact, or whether it's market cycle, or all three of them. So certainly that will give a more tailored, nuanced focus on the current cycle that we're in. But on average, the pattern is exactly what we're looking at right now, as a probable base case trajectory. And buzzword there, probable.
Right.
As you know, leading in with this analysis approach, but certainly worth plugging in. Different scenarios, positive or negative. The one thing I would say is just beware of overfitting statistics, and I say this carefully because, of course, it's something that I do just as much as other market experts. It's useful as a reference guide, but often only that. Market reality is exactly what follows in real time, and so that continues to be a live feedback that we continue to learn from stage by stage. But at the very least, having a reference point is useful, but one that is best used in the context of multiple scenarios, and then ultimately after the fact confirmation. Having a review on the big picture global ranking model, the same framework that we looked at before. This shows the rotation that is played out post-election. Recall, it's that those risk proxies that predicted the outcome, but also succumbed to the excessive fever and euphoria. And essentially, it's those risk proxies: Bitcoin, equities, as well as rates, with a mix of revived animal spirits, but also inflation, higher expectations for inflation with the fiscal policy impact. Some of the surprise that happened, of course, we saw an unwind in gold. You can see that just from left to right. Long-term trend remains strong, but short-term, after being so strong for so long, 40% from low to high this year, outperforming the equities. At some point in time, a healthy correction was likely. So that's what we're seeing here and now. But there is an inflection point ahead, and these risk proxies are likely toppish and due an unwind as part of a profit-taking stage to come. One quick point I wanted to highlight on the question of crypto and gold. I know these are two favored markets generally, and with the RV audience, is a smart diversification of the two. As both markets break records on the upside this year, 2024, it is worth owning a mix of the two rather than one or the other. So that way, as they both go up, it's a double win. But more importantly, as the volatility signatures return and that risk reward profile changes, it is worthwhile weathering the changes by owning both to different degrees, typically an 80-20 mix, 80% gold, 20% Bitcoin, or higher or lower according to your threshold. But the point is, you fare out better by owning both as part of a bold strategy, Bitcoin and gold. And you can see here the rotation over the last few years. This is based on the first half of this year, not complete. It's something worth keeping in mind, particularly as markets get frothy.
Ron, this is such a great chart, and I think this is so well framed as you discuss it here today. Very often this is framed as a food fight between gold and Bitcoin. But what you're saying here is quite the opposite, which is no, this is about long-term diversification, and it's about hedging against potential inflation risk rather than this war of words between the gold folks and the Bitcoiners.
Particularly this year, when both markets have broken records and outperformed. There were times when gold was most unloved. Everyone wanted to own it, but couldn't see the absolute return evidence. And clearly this year, it's gold has shone. But that's also been overshadowed by Bitcoin hitting the six-figure milestone, 100,000 as we speak. And so instead of fighting between the two in an inflationary environment where debt is still a gorilla waiting to be dealt with. Certainly owning both more gold and a little bit of Bitcoin or other crypto coins makes sense. In addition to the fact that currency continues to devalue, the money in our pocket is weaker day by day, and so hedging that clear and present risk scenario, is best. And central banks around the world are doing exactly that, as well as private investors and institutions.
Well, Bitcoin is damn close to that 100K glass ceiling, as you framed it, at about 96,000 right now, a little over 96K as we film. If we could just flip back to the prior chart, because Ron, this is always my favorite chart of yours. I love this because it just conveys so much information about your view of the world right there. And the thing that struck me most when I first saw this is it's really interesting. I think this may be the first chart I've ever seen of yours of this kind that had the strategic, tactical, and active number one position the same across all three time horizons in that Bitcoin.
Yes, absolutely. So we're looking at calendar timeframes, long-term 1 year, medium-term quarterly, and short-term monthly. So they're all within trading or investing portfolio realms. And certainly when they all tally up, that's just telling you exactly what you already know. This trend is either strong or weak. And then the question of Bitcoin, clearly that's been strong, strong, strong. Previously, it was gold to a various degree, and then partially China in the sense of capturing that 50% upsurge post government stimulus. So we've had some rotations over the last few weeks, mostly inflation resurgence related, as well as more recently election fever and more of the same euphoria from this strong risk market that we've been in. What's interesting, of course, is when we get a dislocation in those strong trends, and that's what I'm expecting into the new year of 2025. And that's why having a model like this is worthwhile, because you can watch it in real time. And instead of kind of marrying up to whichever market we love most or are making more money in, we can have that big picture view of how greed and fear and ultimately money flow is rotating around the world across asset.
We talked about the best of the best. Let's talk about the worst of the worst in your view here. Strategic, long-term, weakest single item, oil, rising a little bit over the tactical and short-term. But why strategically so negative on oil?
Great point, and I'm constructively bullish on oil in terms of upside surprises likely ahead, both on the chart tactical perspective, but also upside risks vis-a-vis policy friendliness in this new administration. Drill, baby, drill, is the old saying. Now will likely be in terms of opening up the energy sector in the US, but also the geopolitical risks which remain a risk premium to the oil chart. Now, looking at this, pure trend analysis model, it tells us what we already know, that gold in absolute relative terms has been underperforming, but it has held that support at oversold conditions if we look at the chart. And I'm happy to bring up that chart for future discussion, because I think that is the one commodity outlier that will likely hold its ground and produce some upside surprises, particularly non-consensus upside surprises. And it's worth looking at oil, I should say energy, in equity terms, because that is probably the stronger manifestation of the energy move. In 2022, when inflation was real and back, the energy sector was one of the very few that outperformed in a strong way. And I think it's something for us to keep in mind.
Shall we take a look?
I don't have it ready here, but certainly on the underlying chart of crude oil, case in point, I can bring up the real-time chart in a second, which shows that market.
Hey, by the way, while you're pulling up that chart, I'll give you a little bit of color here on some breaking news as we record here on Monday morning, November 25th. article out, front page of the Wall Street Journal right now, talking about Scott Bessent, who is President Trump's nominee to lead the Treasury Department, Secretary of Treasury. By the way, if you're interested in a deep dive conversation, I did a fantastic conversation with Scott right on Real Vision. You can go and search for that and check it out. But Scott Bessent talking about this three arrow approach, echoing the late Shinzo Abe, talking about these 3 points, a 3% reduction in the budget deficit, 3% getting GDP to 3% growth, and producing an additional 3 million barrels of oil or its equivalent on a daily basis. This, according to the Wall Street Journal. But this touches on your point of drill, baby, drill about the expansion of American energy policy.
You can see on the real-time chart live crude oil holding. So underperforming, yes, we know that, but holding its floor between $65 and $62, or call it 60 round number. But either way, it's holding. So that is a make or break level for the crude oil market and energy in general. If that were to hold, certainly that would be a constructive, bullish case for what you just said in terms of policy-friendly environment in the new U.S. Administration, as well as the recent appointment cited. In addition to ongoing geopolitical risk premium that remains. And from a chart perspective, the best we can do is watch this chart and see which way it goes. Let Mr. Market decide. But ultimately, that will be the key area to watch. So switching to U.S. equities, the risk proxy, which has experienced the election fever pre and now post, and likely to be part of that playbook strategy of buy the rumor, sell or fade the fact going into inauguration, that continues to be part of a triple whammy headwind, which we've been talking about in previous sessions, Ash, and that is momentum, extremes, potential unwinding, rotation fragility, although more nuanced now with small caps popping to the upside and potentially having a pump and dump reaction ahead. And then lastly, which is more true now than ever, that bearish timing confluence that remains. So if we look at the updated chart on momentum and more specifically the trend pattern and momentum exhaustion signals, here we see an updated chart of where the trend is at into the 6,000 psychological level. Interesting that key risk markets going into and out of the election are hitting these key milestones, which is a great thing to experience, but also one to be cautious of, because they often do produce make or break reactions. So S&P 500, as an example, is into that 6,000 mark, which also serves as a trend ceiling resistance and a potential trend wave exhaustion signal, wave 5, which could create a sharp reversal back into the election lows of 5,700, which is also a trend support area. Now, on the follow-up chart, this shows...
By the way, those are DeMark indicators you're talking about when you've got those numbers up.
Yeah, so an overlay on that trend analysis is the momentum indicators based on Tom DeMark indicators, which I know is shared on the RV platform, and Tom DeMark himself has a training insights on the Academy, so please look there for more information. But essentially, it's part of the market timing toolkit that I look at, and what it shows is a legacy and still active, depending on which time frame you look at, time exhaustion confluence. So that's on the monthly, weekly, and daily. The weekly one has neutralized for now because the markets have continued with that election fever, and so that's on pause. But if you look at them together, what it does show is you get a high probability market exhaustion signal where the risk zone is just above the psychological level into new all-time high territory at 60.50. If the market breaks above that, as is going to be obvious anyway, because that would be the resumption of the uptrend, then we can consider a melt-up extension bullish scenario. But if it doesn't, and it loses momentum and reverses into this key short-term tactical area, what I call the election price gap, that's what led to the fever and the euphoria. If we show signs of weakening into this area of vulnerability, previously strength, between 58.70 and 57.80, so just about a few hundred points or so, that's going to be your early stage signal that the market is hot, overbought, and likely to unwind to the downside. And just to reframe, the big picture risk scenario that we've been looking at all this time, Ash, it continues to be, potentially following the historical rhyme, not repetition. It's not a one for one, but a historical rhyme of the '08 corrective pattern. Why? Because it's the bear case scenario, but the other reason is it's a bear case scenario that ended with an all-time high. So it was when consensus were the most bullish, the most euphoric, and the most succumbed to fever, both in terms of Fed policy after the pivot, but also after the election. And it was thereafter that we got the rest of the fall in the following year. In this case, '07 into '08, here and now, between 2024 and 2025. Risk scenario, if it plays out and proven correct. If not, then we get a melt-up phase and look for another analog that might match up with that. But for now, this is the base to risk case that I'm working with. And the danger zone confirmation would be near the levels I just cited, 56.70 and 5,400 on S&P 500.
Ron, let me layer in this question for you. You're looking at DeMark signals. You're looking at the cyclicality around elections. One point here, maybe the obvious one that I want to make, is on a trailing 12-month basis, S&P 500 up nearly 32%, roughly, if you want to ballpark it, about triple the average annualized return on the S&P when you look back over a longer time horizon. When you talk about that level of increase, nearly a third on a trailing 12-month basis, how does that impact the way you view it when you just look at that just tremendous bid it's been catching?
Strong momentum is strong momentum. And the trend is your friend, but it typically leads to stages of exhaustion and then signs of an unwind and a reversal. And the most poignant market reversals happen when we least expect it. So not to say that we should cry out wolf every single time the market's strong, but we should at least factor it in as part of a scenario planning framework. And that's what I've always been big on for years. Not one-way trading up or down, but at least being aware of both sides of the trades. And certainly the most successful traders do exactly that. They can be bullish as hell or bearish, but they will flip to the other side in the back of their mind and mentally game what that could look like from a risk-reward perspective. My concern is that more people are narrowly focused one way with that consensus view, which has just got stronger post-election for different reasons. And that's when the so-called crowd and consensus opinion often gets it wrong.
And by the way, we should say that's why you look at 3 time horizons on my favorite chart.
Yes, absolutely. And in a game of probabilities, not certainties, when you get, whether it's life or markets, when you get confirmation across timeframes, as well as various overlays, momentum, rotation, and timing, then that does make a stronger base case. And ultimately, if the market continues being the market and moves in the way that it already has, then essentially we're back into linear extrapolation world. All good. But again, just keep in mind the risk scenario. Remember that educational insight we shared last time on FOLO beating FOMO during moments of volatility. There's a reason for that. when things last too long and they're too strong, then the asymmetric risk is to the downside. So be careful of trying to pick up that last penny in front of a steamroller. It may feel good in the moment, but it often ends in a very bad way.
Right. Very well said.
And just to follow on in terms of the risk scenario, I always save this chart for only the most likely bear cases, in which case they could be a variation of three. What I've long called the good, the bad, and the ugly. For any of you cowboy western Clint Eastwood fans, essentially the good is 87 and 87 crash, and the 2020 COVID V-shaped reversal, so sharp that most people missed 1/3 of the recovery up. Then the bad in the middle in amber, that's the 2008 global financial crisis compared with the 2000 tech bubble, both down 50% in price terms, but in time duration, 3 and a bit years on average. And then the ugly 1970s and 1929 peak and Armageddon crash. Essentially, you either get a sideways volatile roller coaster ride, 1970s with inflation, with geopolitical tensions and various other disruption, or the waterfall decline. My view in terms of risk scenario ahead is likely a hybrid of bad and ugly. So have a strong cup of coffee or something even stronger if this were to play out.
Hey, let me ask you this. And one of the things I think that's so great about this is that you're measuring those shocks on two axes. You see that massive ugliness, the 17-year up and down whipsaw, and 2.8 years, quite a long time for the 1928 crash. Obviously, uh, looking at that in retrospect, hindsight is 2020. But do you have a sense of how long the duration of a period of volatility in these markets could be, and how would you begin to extrapolate from that?
It's a great question and one that is under asked and understated, purely because we typically think in price terms mostly,
Right.
or in terms of headline sound bites. So if someone says it's a bull market, it's a bull market. We just echo the same sentiment, bull or bear. But the reality is, there is a market anatomy, and that is best learned by becoming a market historian and going back in time and looking at the price and time patterns. But circling back to your point, time is often missed. So in the case of the good market shocks, it's so quick that you can be forgiven to have forgotten what happened because it was just, it was hard, but it was fast. And so 87 is often described in that way. You walked into the office and all of a sudden the crash happened. And a month later, we're back in recovery territory. That was almost the same in 2020. Of course, central bank policy intervention assisted as part of the reopening and liquidity shift. But that is not true in the bad and the ugly. Duration really did last longer. On average, it's 3 to 5 years in a normal business cycle after a healthy shakeout. But of course, there are outliers, and the 1970s is probably the biggest in terms of long-term duration. The reason why I think it is likely a hybrid of bad and ugly in terms of the pattern, both price and time, is because of the debt problem that we have and the inflation implications, as well as the level of euphoria that we continue to stretch on as part of that elastic band effect, as and when that does mean revert, then we're likely for a long and drawn out shakeout process, which I think is a few years at best. And then, of course, the implications of what type of trend will likely happen, sideways, volatile, or down, we'll find out in time.
Boy, I hate to even say this, but if those are the two precedents that you're looking at, high levels of debt followed by euphoria. I think about the chart in the upper right-hand corner there, the Nifty 50 and the explosion of debt over that period of time. I'm not saying I'm bearish here, but I'm just pointing out those 2 points most resemble 74 oil shock.
Yes, and certainly we have the geopolitical implications of that period, which were strong. Um, I mean, essentially, there's different analogs. I mean, that we can use. Here are the ones that uh, let's say the select choice that I'm working with. But there are many others. If we also consider the macro backdrop along with the market dynamics, and then the variations that will likely exist. But the main benefit of doing this type of market scenario analysis is to be prepared for the unexpected. And right now, the market's looking up, and perhaps not factoring in what a new change of season from summer to winter could look like. In which case, I think it's worth at least evaluating some of these examples and building a stress test, both for the strategy and the portfolio.
Well, with all that said, the sun is very much shining right now.
Well, I'm in the UK and we're going into winter right now and it's cold. So I'm happily looking at some of these risk and stress scenarios, but I'm optimistic after winter, spring follows. That's true in both life and markets. So as part of the triple whammy headwinds for risk markets and US equities, case in point, momentum is the first piece, rotation is the second. And this is really important because this is what's happening underneath the surface. And so while in absolute terms, the market's at all-time highs, why is that happening? What sectors are leading the way as part of that business cycle? Now, we know for the last year or two, if not more, and likely in the future ahead, it's been tech as part of the technology and AI disruptive innovation and melt up, which has led to the concentration risk. Now, that concentration risk, depending on which proxies you look at, is clearly at record highs. Some people say Y2K, others say even further back. But the simple point here is that ultimately that upside beta is great while it's pushing higher, but it's a risk if and when it starts to get hot and unwind. Now, what's happened in the second half of this year, we did get a change of leadership, in all fairness, and credit to the market. And that is a leadership that then became broader and laggard driven in terms of the markets, which were the sectors that were the weakest, played catch up and then became the strongest. Now, you can look at this in one of two ways. One, stronger breadth, healthier lifeblood of the market, and therefore more sustainable upside. Or two, this is small cap. They are more volatile and sensitive to both market regime change and macro policy. And while it's holding strong, that's good for the market, but be very aware of the volatility signature, which typically behaves in what I call a pump and dump manner. So it will jump up and then cliff drop when you least expect it, just because that's the nature of small cap, particularly when you're late cycle and there's a big momentum chasing euphoric sentiment out there. So just because this sector is leading doesn't just mean that the market is strong and that will continue for much longer. We should still be cautious on this, the nature and the style and the stage of sector rotation.
Yeah, Russell 2000 year to date up nearly 37%, outstripping the pace of the S&P 500. But to your point, when you look at that chart, a great deal more volatility.
Yes, and hitting an all-time high, strong move and strong resilient trend, but super sharp and likely overheating, particularly if the view is, which mine continues to be, we're in late cycle territory in terms of business cycle, and therefore risks are continue to be to the downside. Keep in mind, if you look at the stocks in the New York Stock Exchange, market breadth remains weak. So even if we get positive sector rotation and new leadership, overall, the individual sectors and stocks are still weighing lower.
Yeah, I was going to joke. Well, what isn't at an all-time high right now in U.S. equity markets?
Exactly that. All part of the everything up strong trend and potential, bubble froth that we're experiencing. Not to say that we can't have, new paradigm shifts and future disruptions continue. It just means that, here and now, there needs to be some kind of healthy shakeout for a new bull cycle to truly reborn, rather than building on the ashes of past euphoria and debt-ridden, potentially inflationary risk.
Ron, and that stress may be exactly the point.
Yes, indeed. And for that reason, last but not least, the third factor of the triple whammy headwind is timing, at least in terms of the various overlays I'm looking at. But to add, this also shows up if you look at cross-asset regime change in rates, inflation, and potential commodity leaders. If we just look at bearish timing, the short-term timing model based on the FSC, Foundation for the Study of Cycles, is showing a potential end-of-year rally, but ultimately an unwind into the new year on the back of that two-stage pattern I alluded to with the election, so into inauguration. Long-term remains toppish into the new year of 2026, which is why I'm playing on the 2007 and 08 analogy. Seasonality tells us what we already know. The year-end rally typically happens, but because we've had a strong first half of this year, the asymmetric risk remains to the downside. And then lastly, that chart that we opened with, the election fever playbook, buy the rumor, fade the fact, does also echo what is likely to happen as markets unwind, both in terms of profit taking, but also policy reality check. So this is a high probability scenario in the short-term tactical framing, but also one that is likely part of a longer topping process in risk markets.
Ron, these are always fantastic conversations whenever you join us. Strategic, thematic, really cross-asset. I always enjoy these conversations with you. I should point out the obvious, not financial advice. Please do your own research. But Ron, we've covered a lot of ground as we always do during these conversations. Final thoughts, key takeaways that you'd like to leave our viewers and our listeners with.
Well, stay focused on markets. Continue to trade the trends with prudent risk management, and be aware of changes in season and market regime, particularly if we've had a strong summer of euphoria with winter likely ahead. Study the charts, learn from the historical patterns, and continue to tune in for future discussions that we have, where we will be looking at top of the market moves and how that might impact your portfolio.
Definitely continue to tune in. Really looking forward to having the conversation with you after the inauguration to see where we land.
Thank you very much.
Thanks, Ron. And by the way, I should say one more time, tickets for the upcoming in-person crypto gathering in Miami now up for sale. You can head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.